Hey everybody, and welcome to this video. My name is Chris Harris, a certified financial planner. And today we're going to be talking about life insurance and what you actually need to know when it comes to all these different policies. As a disclaimer, this video is for informational and educational purposes only and should not be considered investment, tax, or legal advice. Okay, so we've probably heard before, you probably heard about life insurance, right? Maybe you needed a policy, somebody told you you needed a policy, or maybe you have a policy. Okay, so we're gonna uncover really what these different policies mean, how you can use them, and really do you need one? Okay, but first, what I wanna do is I wanna start off by talking about what the heck is life insurance in the first place. So, just really in a simple way, life insurance, and we're just going to use John and Jane. Okay. So John and Jane, they are husband and wife. They live together. John and Jane. And one day, John's like, hey, I want to protect Jane if something was to happen to me, right? So he went out and he bought a policy, a life insurance policy. Okay. And that policy has what's called a death benefit. That death benefit, it could be whatever, right? 200,000, 500,000, a million, 2 million. So he's got a death benefit and he is going to pay this policy. He's going to pay into this policy his premiums every month. Okay. When he dies, if the policy is still intact and active, so he passes away, this death benefit then transfers to Jane tax-free, and she can use it to pay off debts, to, provide for her family, whatever, right? That's what we generally use, or what you've probably heard about using life insurance for. So it's really what it boils down to is protection, okay? So we use this for protection for our family. And so that's really the basics of it, but there are more uses. So if we look at life insurance as a whole, we can say we can use this for estate planning. And we did this in a different video, the ILIT video, so you can go back and watch that. It's an estate planning strategy, and we can reduce taxes. So tax strategy. We can do business succession, so we could do buy-sell agreements, things like that. We can also use this for protection, like we talked about. So that could be financial needs, mortgage, debts, other debts. You could pay off other debts, things like that. We can also loan against permanent insurance policies. So we can use loans. There's some strategies there that we can use. So there's a lot of different things that we can use life insurance for, but we don't want to get too overwhelmed with this. The purpose of this video is really to go over the different types of policies and how those can kind of fit into maybe your needs. Okay, so we'll just erase this real quick, and then what we want to do now is just dissect really the type of policies and what's made up of these policies. So for example, if we look at permanent insurance, so we have permanent insurance versus term. So if we look at this, we have a few different components of permanent insurance. So we have a death benefit, okay, which is the benefit that you'll receive once, or the beneficiary will receive once the insured passes away. And there's also, with permanent insurance, a cash value. Okay, so we put our premiums, we'll pay our premiums into the policy. This cash value can grow. It can have a growth component. Depends on what kind of policy we have, but you're generally going to have this for life. That's why it's permanent, right? Permanent insurance. So we're going to have it for life. If you pass away within this time frame, You get the death benefit, but you don't get the cash value. Okay. Now, what happens if you decide you don't want the policy anymore? You've paid into this cash value. Well, you can take the cash value, but you don't get the death benefit. Okay. You just take the cash and go. So if you've heard of like a savings component on kind of the permanent insurance side, that's what they're talking about, is that cash value. Okay. Generally speaking, these policies, these permanent policies, are significantly more expensive in terms of the premiums you pay. Okay. Term. So we look at term. We have a death benefit here. Again, amount that the beneficiary will receive once the insured passes away. And this is for a term period. So it could be 10 years, 20 years, 30 years, whatever, right? If the insured passes away during that time period, that death benefit goes to the beneficiary, no problem, right? They're still going to pay those premiums into the policy, but there's no cash value. There's no savings component. If the insured passes away, say in 22 years, so 2 years after the policy has lapsed, there's no death benefit and there's no cash value. You just paid in the premiums, you walk away empty-handed. Okay? But this is, and due to that reason that you walk away with nothing, these policies are significantly less expensive. Okay, so your premiums that you're putting in are less expensive. Generally, you can get a higher death benefit with a lower premium. With a permanent insurance, you're going to get a lower death benefit for a higher premium. Okay. Okay, all right, so let's go over now types of life insurance. So again, hopefully making this simple, and in a way, there's a lot to these. So there might be, folks on here, life insurance folks, that say you missed all this, that, and the other. That's fine. For this purpose of this video, we're just going to keep this very high level and walk through this fairly quickly. But we have permanent, so we have whole life policies. So we have straight whole life. That is just you're paying a premium that is fixed for your life with a death benefit that is fixed. Okay? Limited pay whole life. And it, as the word says, this is for your whole life, right? You get it for your whole life. Limited pay, you basically pay up front for a period of time. Okay? So you're not paying premiums for the rest of your life. You're paying it for, say, a 20-year pay whole life policy. So you pay for 20 years, you front load it, and then you get it, the rest of the benefit for life. Okay? These are generally the premiums these are going to be more expensive because you're front loading them up front. Generally, for limited pay, somebody that thinks that they're going to live a lot longer. Okay. Let's go over universal life now. So universal life it's going to give you flexibility. For the premiums, it'll give you flexibility on the death benefit. So it gives you the ability to kind of be flexible with that. However, you have to be careful so the policy doesn't lapse. So you have to make sure that you still are paying in enough to get the death benefit that you want. But there's a lot of flexibility with how those premiums, death benefit, things like that work. With this, it is the cash value that you've invested is basically into like interest-bearing account. So it's like you get some sort of an interest, lower cost, more conservative. But it does give you the flexibility. Okay. Variable life. So think of this as like fixed premiums. Okay. Premiums. But you will be invested into variable life in sub-accounts. So you'll have an investment feature. Okay? So with this, and you've probably heard of index variable life. So you can think of this as you're going to have a cap and a floor on your cash value. So your cash value, you're going to have it indexed. So it could be indexed to the S&P 500. Say that the S&P 500 went up 10%. It could be capped at, say, 6%. And so you would get the 6% in there, but say it went down to, -5%, it could be capped at, say, 0%. So there's downside protection, but then there's also a cap on the top end. Okay, so it's just indexed to some index, right? Like I said, S&P or something like that. So that is the index variable life insurance, or variable universal life. So this one is essentially taking universal life and the variable investment component. And we have two different types. We have A and B. So we have a level. So this is kind of going back to, I think I drew this one initially as an example. So you have a death benefit. You have a cash value. The cash value can be invested, but the death benefit is going to be level. Okay. But you can also have that growth component. You can invest it into, whatever you want. So you're going to really open it up to the market. And you're going to have the ability to, pick your funds and things like that. So think of that as like ultimate investment, kind of risk taking. And then you can also have B. So this is going to be, you get your death benefit plus your cash value. So this is going to be, as an example, if we look at this, so we look at our cash value, has some growth to it. 25K, and then let's just say we have a death benefit here at 250K. Well, if you've grown this to 250, the death benefit now increases to 275. Okay, so the 250 plus the 25. Now my death benefit is higher. Okay, so again, a lot going on there, but really I think the key takeaway is universal life. You get flexibility. It's more conservative though in the interest bearing account of the cash value. Variable life, you're more fixed premiums. You have an investment component, whether that's index, variable life, or if you want to open that up, more variable universal life gives you the ability to invest, in kind of whatever you want. Gives you more autonomy over your investments. And you can choose how you want that to look in terms of cash value, death benefit, things like that. So a lot of flexibility. But with all of this, the different choices will affect your premiums. So your premiums will be a lot significantly higher, right, than say the term. So let's kind of look at term now. Term is a little easier. You don't have the cash value as we talked about before. So level term is probably what you've heard about before. So it's just level premiums, and then you have it for say a 20-year period, and your death benefits level. There's no fluctuation. Annual renewable term is something where you can get an annual term put into place. So it's a 1-year term policy. But you don't have to prove insurability, or basically you don't have to go and do a physician's visit or a physical exam that is required by the insurance company, but your premiums do go up every year. Okay. Then we have just decreasing term. So this one is like if we had, fixed premiums, so our premiums are fixed, but then we have our premiums, fixed premiums, and then we have a death benefit that decreases, okay? And generally, these are less expensive because you're getting a lower death benefit the further it goes out. But that could be used to, like, if you're like trying to protect yourself against like a mortgage or something like that. You want your spouse to pay off the mortgage if you passed away, but the older you get, the more you're going to pay off the mortgage, so you don't need as much of a death benefit. So this would be kind of when you could use that death benefit or term policy. And then, like I said, you can use different things for, like, if you had, a joint life policy. If somebody's to die, then the policy would go on to, first to die. So the insured passes away, it goes to the spouse or whatever, and they can pay off their debt. They can do what they need to do. Or it could, from a company standpoint as well, buy-sell agreements, things like that. Okay, so when does life insurance make sense? This is one I think that is really important to look at, because let's take our John and Jane figures. So this is John and this is Jane. So let's just say they have 3 kids. Now, let's just say they're in their 30s. They have this timeline, okay? When they get to age 65 or whatever, 65, 70, it doesn't matter. But so we're thinking retirement. So when do you think you will retire, right? So that's what you're going to put here. And then they think that they will live until, they're 90. Okay, so this is death. So what they ideally would want to do is, John would say, okay, I want to put a policy on my life like we talked about before. So he's going to get a death benefit that covers this gap. Okay? So we call this the gap from, this is the accumulation phase. So this is, if you think about this, this is when they are trying to accumulate more assets, right? So they don't necessarily have a ton of assets, or maybe they do have some assets that are, they're building, they're doing a good job investing in their 401k, HSA, investment accounts, buying up properties, whatever it is, right? They're accumulating their wealth, okay? And hopefully what that means is that they will have assets that will grow, right? Ideally. So in between now and when they retire, they're looking to fill this gap with something that would provide for the family should something happen to John. Okay? So say he passed away, right here, he's, in his 40s or whatever. Then Jane would receive the death benefit. She would be able to pay for her children, whatever they're into, or, provide for them, pay off some of the mortgage, make the payments, whatever they need to do to survive. And at that point, hopefully they have some assets where she would still be okay, right? Now, you ask yourself, well, what happens when they get to retirement and he passes away at, say, 67, right? We're not insured at that point if we're using a term policy. So this is a term example. So if he passed away, say, 67, they wouldn't get this, right? They wouldn't get the policy. However, going back to their assets, hopefully they've done a good enough job to where Jane would now, kids are moved out, mortgage has been mostly paid off, close to being paid off, whatever. Jane can live off of the assets that they have and, hopefully fairly comfortable. Okay? And that's really when life insurance makes sense, is if we can fill that gap from now until retirement. And then you can make the argument, well, wouldn't it be nice to have a permanent policy in place where the permanent policy will go up until our death, right? And then we still get paid out, right? So Jane, say, John died whenever. He could die at 68, 69, 70, whatever. She would have more assets and she would have the payout from the death benefit. Well, if if you think about it, you're paying in more of a premium. Okay, you're paying more of a premium up front, okay, for this whole life policy or universal, variable universal. You're paying a higher premium, which could potentially take away from putting money into other assets for growth. Okay. I generally don't recommend, folks. I think permanent policies are useful in very, very little situations. That, like, we talked about the ILET. There's certain estate planning things that you can do. Typically, those are for very, very few people, few folks that have tax or estate situations. But they can be great for those situations. I think for most people, term is going to be the most affordable and beneficial option that you can use to supplement and really mitigate your risk for if something was to happen, during your, career years, if you will. So pre-retirement years. Beyond that, your assets really should be able to get you to end of life kind of scenarios if you're planning correctly. So that's really where I tell clients and other folks is that if you can plan correctly, you can get a lower premium, a good death benefit that's really going to fit, and you're not paying a ton out of pocket, but you're still protected. So I think life insurance makes sense. I think, I have a policy on my wife. So if we were flipping on the spouse's side, if my spouse were to pass away, so say Jane passed away, well, now John, right? So John's living with no arms. We got to put arms back on him. So John, he's living. Jane passes away. Well, John makes the money. Let's just say he works. Okay, he's got a great job. Jane's a stay-at-home mom. Why would she need a policy? Well, if Jane passes away, who's going to take care of the children? Okay, maybe they're younger children, right? So John would want to get a policy on Jane's life, so that if she passes away, that the kids can, he can hire a nanny, he can have extra funds to, do that, make sure that the kids are taken care of. Or if she did have, maybe she helped supplement the income, that would be really important too, so that he could get a policy that would help supplement the income that she did make. Okay. So really what we're trying to do is we're trying to look at risk and say, how do we mitigate as much risk as possible by putting a policy on the life of our spouse and get that protection window, but still have enough cash flow to invest in other assets for, wealth accumulation, so that if we were to pass away early, we're still protected, but not, paying these huge premiums, for the rest of our life or for a long period of time. Okay. So how does this all shake out when it comes to financial planning? Well, what we do is we look at the life insurance gap analysis. So this gap analysis here, this is our Chris P. Bacon and Marsha Mello. These are two fictitious clients. We look at the scenarios, and you don't need to worry about these numbers. These are just fake numbers, but we're looking really at what benefits we have, okay, and what we're recommending, and why. Because what we want to do is we want to see portfolio assets. So if we look at this, portfolio assets after death, so we look at, we're in the hole before, but if we have a policy on the life and, Chris P in this situation dies early or whatever, then we will have, assets at the end of life will be taken care of, right? So we look more granular at the overall situation to make sure that it even is a fit. If we're, really kind of in our elderly years, we don't necessarily need a policy if we have enough assets that, make it so that we can live off of. Right? We don't necessarily need a policy. And I think that's kind of where the argument comes into play, is we get some people that say, oh, you need a policy no matter what, and so on and so forth. I think if you're doing financial planning and you're looking at the whole picture, you can really make the case to whether you do need it or you don't need it. So that's just something to think about as you're going through your own situation, your own policies. I've met with folks and they need, they just psychologically needed the policies there. But it's one of those things as you talk through it and you look at the assets that they have and say, well, maybe we don't need these policies anymore. Maybe we're just paying these huge premiums every month. A lot of these permanent policies that we just are paying for, and they have smaller death benefits. Let's maybe reduce those, and look at other ways to generate wealth, and generate our assets. Because from where I look at life insurance, I don't look at it as an investment product. I don't look at it as like a savings account. I look at this as purely a risk protection, or like I said, there are certain strategies that you can use the permanent policies for, but generally speaking, it's more of a protection, as opposed to a wealth creation, which is fine if again, there's different thoughts on that. So it's fine if there's differing opinions on that, but it really just, again, goes back to what is best for your situation and your cash flow, needs. So hopefully this makes some sense and we were able to break it down in a way that helps you kind of understand what your options are and maybe how you can go about purchasing life insurance or not needing life insurance. Okay, we'll catch you on the next video. Thanks for watching.